Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Enterprise Value, EV, and its impact on investment decisions. Enterprise Value Explained. A clear guide to understanding and using EV in finance. Have you ever wondered what a company is really worth? Enterprise value, EV, is a key metric used to measure the total value of a business, beyond just its market capitalization. By factoring in debt, cash, and other elements, EV offers a clearer picture of a company's financial standing. It's widely used by investors and analysts to compare companies and assess potential investments. Unlike market cap, EV provides a more comprehensive view, helping you make smarter financial decisions. Understanding enterprise value. Enterprise value, EV, is a cornerstone metric in finance. It goes beyond market capitalization, giving analysts and investors a clearer snapshot of a company's overall worth. By considering debt, cash, and other factors, EV reveals the true value of a business as if it were being bought outright. It's especially useful when comparing companies of varying sizes or capital structures because it provides a level playing field. Definition of enterprise value. Enterprise value measures the total value of a company, combining its market value and additional financial obligations. The formula to calculate EV is straightforward. EV equals market capitalization plus total debt plus minority interest cash and cash equivalents. Market capitalization. The total value of a company's outstanding shares. Total debt. This includes long-term debt and, in some cases, short-term debt. Minority interest. Represents the ownership stake in subsidiaries not owned by the parent company. Cash and cash equivalents. These are subtracted because cash reduces the net acquisition cost. Why is EV so important? Unlike market cap, which only looks at equity, EV accounts for a company's debt and available cash. This makes it a better measure when assessing buyouts or comparing companies with different financing structures. Components of enterprise value. Breaking down EV helps you see what influences a company's worth. Here are its main components. Market capitalization. This is the starting point of the EV formula. Calculated by multiplying a company's stock price by its total shares, it reflects the market's current perception of the business's equity value. But remember, market cap alone doesn't tell the whole story, as it ignores debt and cash. Debt. Debt plays a critical role in EV. It reflects the money a company owes, whether it's from loans, bonds, or other liabilities. Debt increases EV because it's a financial obligation that potential buyers would have to assume. Minority interest. For companies with subsidiaries, minority interest comes into play. It represents the portion of a subsidiary not owned by the parent company. Since EV reflects the value of the entire business, minority interest is included. Cash and cash equivalents. Cash reduces EV since it represents money that a buyer wouldn't have to finance. Think of it as an offsetting factor. Cash equivalents, like short-term investments that can be easily converted to cash, are also included in this category. Each component adds a layer of insight into the company's financial health. By understanding how these pieces fit together, you can evaluate a company's value more accurately. Why enterprise value matters. Enterprise value, EV, is more than just a number, it's a comprehensive insight into a company's worth. By taking into account factors like debt and cash, EV paints a clearer picture than other metrics. Whether you're evaluating a potential investment or comparing companies in the same industry, EV helps uncover the full story. Let's explore 2 critical ways EV stands out: its comparison to market capitalization and its role in investment analysis. Comparison to market capitalization. At first glance, market capitalization seems like a simple and effective way to measure a company's value. After all, it's calculated by multiplying the stock price by the number of outstanding shares. But here's the issue. Market cap only tells you about equity, the value of shares owned by stockholders. What about the company's debt or cash holdings? That's where EV comes in. Unlike market cap, EV accounts for total financial obligations and subtracts cash, offering a fuller perspective. Consider this. Two companies might have identical market caps, but one carries significant debt, while the other is sitting on a pile of cash. If you only look at their market caps, you'd assume they're equally valuable. EV exposes these differences by factoring in debt. This increases EV because it's a liability a buyer would assume. Cash. Subtracted because it reduces the net cost of acquiring the company. In short, EV is a more holistic valuation metric. It provides a clearer understanding of what the real cost would be to purchase the company outright, including its debts and assets. Market cap, by comparison, offers only a piece of the puzzle. Investment analysis using EV. For investors evaluating businesses, EV is a go-to metric. Why? Because it levels the playing field. It's particularly useful when comparing companies with varying capital structures. Some might be heavily financed through debt, while others rely on equity. Here's how EV comes into play when assessing investment opportunities. Identifying undervalued companies. Investors often compare EV to earnings metrics like EBITDA, earnings before interest, taxes, depreciation, and amortization. A low EV/EBITDA ratio may signal an undervalued company, while a high ratio might suggest overvaluation. Evaluating takeover targets. EV is critical during acquisitions or mergers. It offers a clearer view of a company's total cost, accounting for both its debts and available cash. This ensures potential buyers aren't surprised by hidden financial obligations. Comparing across industries. EV allows apples-to-apples comparisons, even when companies operate differently. For example, a manufacturing firm might have large equipment loans, while a tech company could be debt-free. EV adjusts for these differences, making it easier to spot true value. Think of it this way. If market cap is like glancing at a car's price tag, EV is like checking under the hood, assessing the engine, and factoring in repairs. It's the deeper evaluation needed to make smarter investment decisions. Investors trust EV because it uncovers the hidden details market cap leaves out. Debt, cash, and other obligations matter when you're spending money or investing it. Without looking at EV, you might miss critical red flags or exciting opportunities. How to calculate enterprise value. Calculating enterprise value, EV, might seem complicated at first, but it becomes simple when broken down into its main components. EV provides a full picture of what a company would cost if you were to buy it entirely, taking into account not just stock value but also debts and available cash. In this section, we'll show you the formula and walk through a real-world example step by step. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.